Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two rather great value stocks to consider buying in April and possibly holding for a really long time. The two stocks we're looking at today are a health insurance powerhouse and a glass company. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for looking at some of our services, portfolios, and more. So before we jump into these two value-focused stocks that are highly ranked on the Zacks rank, I want to just go over where the market stands as we head into the second quarter, just to give a better sense of maybe why we're looking at these two stocks in particular. So obviously it's been a pretty exciting and volatile first quarter of 2023, though it's been largely upbeat. Despite all of the real unknowns and those ongoing banking jitters. So Wall Street appears to be shaking off those fears, though. The rapid collapse of Silicon Valley Bank and Signature Bank, they're not as worried, seemingly, that's going to cause widespread turmoil in the regional banking industry. So both the S&P 500 and the Nasdaq are way above now those SVB bank bust lows. So we saw First Citizens agree to buy large swaths of Silicon Valley Bank, which is a seemingly positive sign. Of course, though, we're going to have to wait probably much longer to see if we're officially in the clear. But Wall Street seems to think that those SVB-related issues have been contained, at least for the near term. Plus, many are starting to take the collapse and the subsequent financial tightening that will come with it as a positive sign, as it's going to do some of the Fed's job. Jay Powell essentially alluded to as much when the Fed did raise rates by 25 basis points in mid-March. So that also helps signal confidence that the central bank seems pretty sure the financial system will be able to handle even higher rates going forward. So traders are currently split down the middle, essentially right at 50-50 if the Fed's going to raise rates by another 25 basis points at its early May FOMC meeting, so that next meeting they have, or leave rates unchanged. These percentages have already swung in the last few days, and they're likely to continue to swing in the coming weeks. And then if we look longer term, the traders are essentially saying there's only going to be one more hike this year, and it just depends when it comes. And the market's now kind of pricing in that there's going to be a chance the Fed starts to lower rates by near the end of 2023. Many disagree with that outlook and think the Fed and Jay Powell won't even consider lowering rates until 2024 because they view tackling inflation as the key and they don't want to give up before they actually declare victory. Still, no matter what, the market's looking pretty bullish at the moment. Traders in Wall Street saying that they know better than the Fed in terms of inflation, and the Nasdaq's now up about 15% year to date. It jumped on Wednesday and Thursday, and it was up about 1.2% the last time I looked on Friday to end the quarter on a really bullish note. The S&P 500 is also ending on a really positive note. It broke back above its 50-day midweek, and it also climbed on Thursday and was up about 0.9% the last time I looked on Friday morning. It's worth stressing once again also that the S&P 500 and the Nasdaq have experienced those so-called golden crosses so far in 2023, which is when that shorter-term moving average, in this case the 50-day, crosses above the 200-day, so that long-term trend. So technical traders view that as a positive bullish signal. So like it or not, these big moving averages are heavily tracked, so it gets a little harder to be a bear when both those crucial indexes are trading above those levels. So obviously, we don't know exactly what's going to happen in the near term. There's still many unknowns, inflation being one. With that said, though, the big news out Friday morning was the Fed's preferred inflation gauge, which is that PCE, came in at about 4.6 in February, which was down slightly from 4.7 in January. And then on a month-over-month basis, it climbed at 0.3% in February from the prior month, which was down from 0.6% in January, and also came in below the 0.4 estimate. So that's really Wall Street seeing that as a positive sign. That's probably why you saw a decent amount of buying on Friday morning. And then in the consumer spending front, it increased a seasonally adjusted 0.2% in February. This is compared to January's revised 2%. So spending really slowed down in February. In that January, it could have been kind of a blip on the radar as people continue to spend in that post-holiday season. So it's good to see consumers slowing their spending, which will lead to lower inflation, and lowering inflation is good for the market, as they see that as the Fed being able to essentially maybe raise rates 25 basis points more at some point in the next couple meetings, and then leave them there, and then slowly start to lower rates in the, as they say, the back half of 2023 at some point. So all things are looking pretty positive as we head into the second quarter. The next crucial step will be to see how earnings hold up, which the big banks start to report in mid-April, and then we really hit that busy part of the first quarter earnings season. So that's going to be the next thing to watch out for, is if earnings estimates can hold up, because right now we're calling for a dip in 2023 as a whole, but to see some growth in Q4 and then come back in a big way in 2024 and 2025. So with this in mind, though, we could possibly see some more selling pressure and possibly choppy trading in the coming months. Technical traders are looking for maybe some chop around in the next few months before we get some more news and some possible catalysts on what's going on. So with this in mind, also QQQ is near overbought and valuations are surging, as many people have just dove back into chip stocks and all these beaten down tech names. So that's why we're looking at two value-focused, highly ranked Zacks stocks that should be able to weather kind of any economic storm, or really survive no matter what the future looks like in the near term and the long term. So that's why we're looking at Humana. It's the first stock on the list. It trades under ticker HUM. Humana is a health insurance firm that offers a wide range of plans for Medicare, Medicaid, dental, vision, pharmacy coverage as well. So the pitch overall for 2023 and beyond is pretty simple. As uncertainty rules overall, it's good to take advantage of industries and stocks that have proven they can really thrive during market downturns or upbeats, bull runs, bear markets, even the toughest conditions. And then overall healthcare needs don't stop no matter what. And Humana's outlook reflects that, which we're going to get to in a bit. And the U.S. spends a ton of money on healthcare, and the population is growing older. That there's no denying that, and increasingly unhealthy, which pretty much fits directly into Humana's core business. So their company's bread and butter is that Medicare Advantage segment. Humana's total Medicare Advantage enrollment hit about 5.1 million at the end of 2022, up about 3%. And its total Medicare segment was up about 1.2% to 8.7 million. Humana reportedly holds around 20% of the entire Medicare Advantage enrollment market across the country, coming in only behind United Healthcare's roughly 30%. So Medicare Advantage, they see that as going to be still that booming business for years and years to come. Humana averaged 12% sales growth in the past 5 years as part of a really steady, roughly 20-year run on the top line, besides one tiny little pullback. This includes 12% revenue growth in 2022. And then looking ahead, Zacks estimates call for its revenue to climb another 12% in 2023 to reach about $104 billion, and then climb another 9% in 2024. So steady, low double-digit revenue growth. And then we're calling for another 11% adjusted earnings growth this year, and then 13% next year. And then in terms of individual projections for that Medicare Advantage membership, the company said when it reported its fourth quarter results that it expects to grow its membership by 14% this year. And they said that's going to be meaningfully higher than the industry growth as well. So that's good news for the company individually. Humana's positive earnings revisions help it land a Zacks ranked number 2 buy at the moment. And it's also managed to top our quarterly earnings estimates for 5 years running. Humana executives also have projected over 42% of eligible Medicare age population will enroll in a Medicare Advantage plan. And so that's roughly 30 million people out of around 65 million people. And then other industry tracking groups have projected that figure will reach about 50% within the next few years. So overall, this is kind of the figures I'm talking about, why you should be rather bullish on Humana, is that millions of people are aging into that group of 65 or older who qualify for Medicare offerings. The total U.S. population of those 65 or older is projected to reach about 72 million by 2030. and almost 90 million by 2050. So the U.S. is just getting older, as are many other rich nations. The 65 and older group's share of the total U.S. population is projected to reach 25% by 2050, up from just about 16% in 2018. And obviously that aging population comes with more medical issues, and we're already in a relatively unhealthy country. On top of that, the U.S. healthcare spending is projected to grow at an average annual rate of about 5.4% to reach 6.2 trillion by just 2028, up from 4.1 trillion in 2022. So the spending is there. It's an industry to be in. Humana shares have surged about 520% in the last 10 years to crush the S&P 500. It's 165%. And it roughly matches its industry, which shows just how strong the space is. Overall, Humana shares are up about 18% in the last 2 years. It's now trading about 13% below its November peaks, as investors have started to dump some of those safety plays, as we alluded to, and jump back into tech. So Humana is now trading at a 30% discount to its decade-long highs at about 16.8 times forward earnings, and 10% under its own median. This also marks a 25% discount to the Zacks medical sector and 10% value versus the S&P 500. The company also boasts an impressive balance sheet. Its dividend is yielding about 0.7%, so nothing huge, but it has a super healthy payout ratio of just 12%, and it's raised its dividend by 24% annualized over the last 5 years. And Wall Street's really high on the stock. 14 of the 18 brokerage recommendations that we have are strong buys, with nothing below hold, and it's trading 22% below its average Zacks price target at the moment. So that's all the reasons why you should consider looking at Humana at the moment as we head into Q2. And now we're going to look at a totally different company that operates in a totally separate area of the economy, but also offers some of these long-term value upsides in an industry that shouldn't be going out of style too much, and that is OI Glass, which trades in the ticker OI. OI Glass is one of the top producers of glass bottles and jars in the U.S. and around the world. OI works with some of the leading food and beverage brands on the planet, and the company's offerings are likely to remain highly popular as companies and customers look to be as environmentally and recycling friendly as possible. OI Glass is in the midst of trying to kind of revamp some of its business operations to help unlock shareholder value. We've seen this payoff in the stock in a huge way over the last several years, and it's projected to continue to invest in the business and return value to shareholders over the next several years as well. So the glass bottle and jar giant hopes its efforts will help return to profitable growth, capitalize on opportunities, reduce structural costs, and much more. The company's revenue climbed 8% last year, and it topped our Q4 estimates by about 20% in January. So looking ahead, Zacks estimates are calling for it to post another about 6% revenue growth in 2023 and 12% adjusted earnings growth. And then we're calling for more growth in 2024 as well on both the top and bottom line. And its improved earnings outlooks help it land a Zacks rank number one strong buy at the moment. The firm has also crushed our estimates recently, including a 19% adjusted earnings beat last quarter, as I just mentioned, for a 16% average in the trailing 12 months. Overall, OI Glass's industry is in the top 30% of over 250 Zacks industries, and its shares are up 35% in 2023 and 70% over the last year to crush its industry in the S&P 500. And this is also part of a 250% run over the last 3 years versus the industrial products market's 75% climb and the benchmark's 64% run. And it's trading at around, last time I looked, around $22.68 per share. So under $23 per share, which is 15% below its average Zacks price target. And it hovers near neutral RSI levels. It's also currently trading a nearly 50% discount to its Zacks industrial products sector at just 9 times forward 12-month earnings. This is not too far above its own 5-year median and 20% below its highs. And Wall Street's also rather high in the stock, with about 5 of the 8 brokerage recommendations that we have for OI Glass coming in at strong buys. So that one was much shorter than the Humana overview, but still OI Glass, as I said, offers value, a high Zacks rank, and the ability to steadily grow kind of no matter what happens in the near term with the economy. Even though we're looking pretty bullish at the end of the first quarter, there's still lots of unknowns out there, and we could see things look a little different in the matter of weeks or months. So these two stocks should help you kind of thrive no matter what happens in the coming months and years for the U.S. economy and the broader global economy. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.